Hey guys, welcome to another video. Today I want to cover junk bonds or high yield bonds, and primarily I'm going to look at the HYG ETF because it is very liquid, but I'm also going to include JNK, which is they basically have the same thing, but they are high yield double B triple B junk bonds, and I'm going to cover why I think they suck. Stay tuned. First, a quick explanation of what is a junk bond? A junk bond represents issues by companies that are financially struggling. So they have a high risk of defaulting or not paying. These are riskier companies. They pay more interest, but there is a risk. And I'm going to argue that the risk right now is not being appreciated. A junk bond is a debt that has been given a low credit rating. It's below investment grade. So these aren't like treasuries. These aren't like AAAs. These are lower, riskier bonds. If we go back to the HYG chart, this is the chart that I'm most interested in. Let me do a weekly chart. If you look at the weekly chart, anytime we have a major sell-off in the market, like a big tank in the market, let me go to the monthly chart because it just looks pretty. 2008, bonds sold off hard. 2015, 2016, bonds sold off really hard. So we have this range somewhere in the low 90s, like 93, 94, 87, 89. That price is a normal, healthy market. People buy these junk bonds to harvest the yield. They want to get that rental income off of the bond payments. In crisis, when interest rates start to go up, they dump these. These go as low as 60. So that's the range that I'm interested considering. Let me just put a range. So if you think of it, when times are good, the HYG might trade closer to 90. In times of panic, it dumps as much as, what is that, 33%? If we look at where it is now to where it could go, it's a 25% drop if this range stays the same. Now if you look at the, I'm going to show the volume. We started to stop the rise, as in it's not getting better. Prices are not going higher. And I'm going to argue that someone shouldn't be very optimistic on the junk bonds, that we might get a time where we're going to test these lows again. Maybe sellers will be less interested in owning this, given the information I'm going to cover, which is inflation and then the historical difference between junk bonds and treasuries. I have the HYG ETF. This is the Junk Bond ETF, a very liquid, very popular fund that holds the junk bonds. And this is the main reason that people and investors and banks buy this stuff. If you look at the yield, it's 4.5%. And that's not the highest it's been, and it's not the lowest. But this yield is 4.4 for the 86 and change it costs to buy it. If the price of the bond fund goes down 25%, then this yield is going to go up. If the bond fund, the price goes up, then the yield is going to drop. People looking to own this are probably better off buying it when the yield dumps, because this is risky stuff. You don't want to buy at the top and then expect nothing bad could ever happen, because it's happened before. It could happen again. The yield must be around 6 to 7%, maybe even more at these lower prices, which is still not great. But what tends to happen is this fund gets beat up and then it recovers, and then you get a capital gain move on top of the yield. This headline just came out this week, last week, I guess, but it's recent news that the consumer prices jumped 6.2%, which means that prices, or inflation, the most common measure for inflation, shows that prices are 6.2% higher than last year. And that's the first time that we've seen that number in a long time. And the reason it matters is that if you're only getting 4.4% in that bond fund, or you're getting less in your savings accounts and checking accounts, and inflation is 6.2, then you're losing the difference. If the price of everything is going up 6% and you're getting less than that, that's not a good deal. So what you would want to not have, you don't want that deal. You don't want to have junk bonds because you're getting less than the rate of inflation, plus you also have the risk. Let's look at the risk. Here I have a chart of the default rates of high yield, and this is the probability, or the rate at which bonds stop paying, or the companies go bust or get into trouble or need to reorganize the debt. And 2008 is an example of a bad time, and that was as high as 14%. This is not this is not current data, but it's got to be close to that given the current prices. The potential risk is not priced in if the yield is 4.4% and the potential default increases higher than what it is now. This is not easy money. You're taking the risk, and that's why the yield is there. My argument is that the risk is going to increase, and that 4.4 is not as good a deal, and that the investors should demand more return. This is a 25-year chart of junk bond rates compared to Treasury rates. The safer government Treasury bonds this is a 10-year. It's down below. And if you noticed, there's just a steady downward move as the rates have gone steadily down. There's been some oscillations, but generally these are historic lows on the 10 years. Also, the junk bonds, they've oscillated far more wildly, and they too have very low yields over the past 25 years. If you look at the highs, it's around 14, 15. It was even higher in 2009. And then 10 seems to be a very common occurrence as far as where the yields go. And right now they're 4.4. Yields can double and triple in a time of crisis, which would be very bad for the bond prices. An investor would take at least a 25% drop if one of those panics occurs again. So very good reason to be concerned if selling begins, or something like the inflation that's happening now, or the possible credit risk wave that's coming from maybe a China default wave, maybe an Evergrande. If that contagion spreads around the credit markets, who knows? But I think something's already started. Let's go look at the chart again. Here we have again the HYG fund, and below we have the volume to give us an idea. On the green days we'll have green volume, and on the red days we'll have red volume. And a trend is considered positive when we have higher highs and higher lows, and it's considered less positive or bearish even if you start to see the highs decline. And that could be happening right now. And if you zoom in a little bit, you see this selling and the volume is starting to pick up. Now, that has happened before, where the market sells off and then recovers. So there's no guarantee that maybe the market won't just swing up. That's possible. It's also possible, though, that because of the inflation data that's coming out, because of the risk, because of the run-up, if you look at the, let's look at the weekly chart here, it is possible that we see some kind of a dip. I don't know if it will happen. I don't know with certainty that it will happen or can happen, but I'm getting prepared. I'm putting on trades just in case. I would love to capture a potential drop in the HYG bond fund. And the way I would do it is just to buy some outright puts. That would be the simplest way. I can buy some put spreads. That also works, but when this moves, it generally the options are generally not that expensive because it's a bond ETF, and it doesn't usually have a lot of volatility, but when it does move, the options explode. And I think it would be multiple. It would be, we're talking 200, 300, 500% move in the options if the market moves. So as many months as possible, as far out, that would be the best way to capture this type of a move. Looking on barcharts.com, they've got some great data for the options. If you look at the most active options and you look at ETFs, what you'll find is HYG is on there. It's the 4th most active ETF regarding options. 473,000 traded today alone, and 89% of those options were on the put side. So normally it's a mix and it does change, but for a while I've been seeing a lot of puts being purchased in the HYG. Now that doesn't mean it's going to go down significantly just because we see a big number right here, but it makes me believe that someone is hedging the downside risk. It might just be a hedge, a normal hedge where a bondholder might be buying the bonds and then putting on the puts because they're cheap, or it might be an indication of a big move coming in the bonds. But this is the type of action I would see or expect if there was a big move or a big concern in something like the junk bonds. Lastly, I'm going to show here the Volatility Index, and if we look at HYG, when there was a big sell-off, let me get rid of volume, when there was a big sell-off in the market, when there was a panic, which was in the health crisis, it was also connected with a big spike and rise in volatility. And if the move in the market that I'm looking for happens, it's going to happen in volatility in conjunction with the drop in the market. So HYG has started to sell off. If this continues to break support, maybe goes lower around that 85.5 range, I would also expect to see the VIX rise and spike to that 24 range and maybe even higher. So this would be like a confirmation of what could be happening in the market. If I jump over to the Dow did start to sell off ahead of time. I say ahead of time because the NASDAQ and the SPY have not confirmed a sell-off, but the Dow is like a canary in the coal mine. It could be indicating some kind of volatility on the way. I don't know for sure. None of this is at all advice. This is all just for education and observational purposes only. But I hope you like this type of content and stay tuned. And if anything comes up as far as this potential move in HYG, I'll make another video. Cheers.